a very good friend of mine for about 5 years now, Kip Herriage, and he is really one of my original mentors to the economy and investing, and I've been following his work unbelievably closely, especially since all of this started going down in 2008, because Kip has just had an uncanny knack for calling out events and turning points in the economy over the past 3 years with unbelievable accuracy, days or weeks before things have happened. And so, Kip, unbelievably excited to have you on the call with us tonight. How are you doing?
Hey, Mike. Great. Really glad to be here.
Awesome. Just to give everybody a little bit of background about you, and it's quite extensive. I'll let you share a little bit of it. But bottom line is you're a former Wall Street guy who was disgusted with what he saw there 25 years ago. Been doing your own thing as an investor really ever since then. You've had your investing newsletter, the VRA Letter. That's VRAletter.com. I want to say for the, past 10 years or more?
Yeah, it started in 2002, so right at 10 years now.
And I believe your average portfolio return in that has been over 100% per year for the last 9 out of 10 years, correct?
Had 1 year under 100%, that's right.
Awesome. Unbelievable. And also the owner of Wealth Masters International, a very large, successful financial education, and also the brand new partner of Crash Proof Prosperity. And that's also the name of your new book, correct?
It is. That's right, Mike.
Awesome. So Crash is unbelievably exciting because you've brought together 3 of my favorite people in the world, yourself, Gerald Celente, Research Institute, who I've been a customer of and reading for years now as well, and Wayne Allen Root, who was a presidential nominee for the Libertarian Party a couple of years ago. So really 3 power in one place, and people can find out more information about all of these things at your website, Kip, which is wealthjournals.com. So we'll cover that later and give those links out again, but we have a ton of information about the economy, current events, and in particular silver, which is why we're holding this call. And but real quick, 2-minute background on anything that you'd like to share with everybody that I did not cover real fast.
You bet. I'd be glad to. Good evening, everybody. And Mike, thanks again for the opportunity. We go back a long ways, and the thing I've always admired about you is you have this unique ability to collect these great books. You introduced me to Mike Maloney several years ago. He's been a key resource for us, and a lot of other folks as well. So thanks for your friendship, and again, thanks for this opportunity tonight. As Mike said, I spent 15 years on Wall Street. I was the youngest VP at Oppenheimer in their history at the age of 27. And after about a 15-year career, I saw what was happening in the dot-coms and all the research I did. And by the way, I lost a ton of money listening to my own investment firm, which Wall Street supposedly. And like probably most of you on the call tonight, I realized at a pretty young age, I was about 5 years into the business when I realized after I lost $1 million in my own money, not including clients' money, after this was in, I guess I've been in the business about 4 years, I realized I couldn't do that anymore. And if I was going to stay in that industry, and I almost didn't, it was that painful process, I realized I had to learn how to make my own money, how to find my own experts, how to develop my own mastermind group, and that's what I committed the rest of my career to. So much success as a financial advisor, companies public. I learned to trust my instincts, and this is something that I really try to teach people. I talk about this in the book, Crash Proof Prosperity, as well. And our objective has always been, either with Vertical Research Advisory in my newsletter, with Wealth Masters, with anything that we do, that I do, my objective is to teach people to be their own expert so they don't have to rely on somebody else. And that's what you're doing here with the Elevation Group, and I applaud you for it. But, it's this, Mike, but my first recollection of investment talk was when my father was buying gold. He was buying into a gold mutual fund, and guess when you think he was doing it? What do you think the price of gold was when my father started buying?
1980, around $800 an ounce.
That's exactly it. He bought somebody else. And I remember then being a school. I remember thinking, and I don't come from a lot of money, so this is all foreign to me then. But I remember just thinking. I remember this almost like it was yesterday. I remember thinking, wow, it's gone this much. Or I overheard my dad and his buddy talking. This guy was a broker. I was like, wow, it's gone up that much. I'm just wondering, is this the right time to buy? And the flip side of that story is my father sold that same mutual fund at the very bottom of the market.
No.
This is the lesson for so many people, because this is what don't buy low and sell high. We do just the opposite of it, and it's the emotion of money that gets control of people. And it's really even very, very difficult for seasoned veterans to combat this, which is why I tell so many people, if you're thinking about going into a trading, do whatever you have to do to change your mind. Let me talk to you for 5 minutes and tell you the whole time with options, which is why I'm not a big fan of options. Lost a ton of money in options because I thought I was smarter than the market. And long term, I think I've proven, what I've done with the VRA and the picks we've had. Where I've outperformed. I don't know. Honestly, I don't know if there's anyone that's outperformed what I've done the last 10 years on the planet. Not trying to be cocky here, but the numbers speak for themselves. But I haven't done it by trading. And so that was really the message I wanted to bring this call tonight, Mike, as it relates to silver. And I want to expand on this a little bit, but I'll shut up here and let you ask your next question. But if anybody's on this call tonight and they're thinking about trying to aggressively, actively trade, even honestly trying to hedge your silver positions, even though I know that was kind of the topic of this call, I'm kind of here tonight. I can show you how to do it, but I'm really here to talk you out of doing it, because we are starting what is going to be the greatest bull market in history in gold and silver. And by the time this is over, and it may be 2 years, it may be 5 to 7 years, but I think it's certainly in that time frame. What we saw at the end of the great bull market from 1985 to the top of the dot-com in 2000 when I left Wall Street, see in the precious metals market. And I'm going to give you some signs to look for so you'll know when that top is coming, but we're nowhere near that.
Well, that's a great transition point, and probably a surprise to everybody on the line, given the title of tonight's call, which is how to protect your profits in silver. But your advice, and I've always looked up to you for mentorship in that, and I will always take your advice over my own feelings, because your life's worth of experience is 10 times more than mine. But when I started thinking about this last week, and like, hey, silver going up $1 a day, it's starting to just go vertical up this wall. How can we lock in on this and protect against the potential, deflationary downside, which may or may not come? I'm going to let you give your opinion on June 30th, when the Fed announces whether they're going to continue or discontinue. And, the initial thought is, hey, let's buy some options, buy some puts on silver to essentially serve as insurance against inflationary crash in the price. And I talked to you last week, and I talked to Ira, and both of you said, don't do it. So I'm going to let you share the lessons as to why you said that to me with everybody on the call tonight. You
bet. And I'm not, by the way, I'll defer to Gonzalo. He's probably more of a silver expert than I am. I'm more of an investor. But I'm a big believer in trends, and this is why I was so glad tied in with the Crash Through Prosperity, the affiliate program we'll talk about later tonight, because that's really what his expertise is. And but I'll tell you, I looked at, after we talked, different ways to hedge. And if you think about what the topic of your call is tonight, that's really what my belief system is. The best way to hedge and to protect your profits in silver is to make sure you don't sell too soon. And I think, unfortunately, a lot of people have missed the boat here. I would, if we took an honest poll in this call tonight, Mike, I would guarantee you that fewer than 20% of the people in this call tonight own a lot of silver. Now, they may have bought it late in the move, and they may have thought, wow, it's really breaking out. And now they're probably sitting on, they bought it late in the move like my father, and they're probably sitting here going, what did I do? What I actually did in the VRA, silver and gold in 2003. I recommended gold at $5 an ounce. I recommended silver at $4.75 an ounce. It was in my fourth VRA update that I did that, and I think I've probably written 1,000 articles over this 10-year period. I don't think that's an exaggeration. I write about it all the time. And the key point really is this. I want people to think about this from a what is the Fed doing and what is a bull market like point of view. And I want you to think about what happened in the mid-'80s. Remember, we kicked inflation. We had a Federal Reserve Chairman and Paul Volcker that was able to take interest rates down from over 20%, over 15%. With Reagan as president, they kicked in the butt. And what happened? Well, two things happened. Very important cycles started. Long-term cycles, and that's what we're looking at here in gold and silver. The first long-term cycle was the greatest bull market in equities in the history, which started in about 1983 or so, and of course it collapsed, and that was in equities. And we also saw the greatest bull market in interest rates, right, in bonds, as interest rates came down. Think about this. We've had now for a 30-year period. And that's about what the interest rate cycle is. It's a cycle. It's the longest of cycles. It's a 20 to 30-year cycle. And now we're coming up on this time frame where you look at where we are. And this is a very smart group on this call tonight, so I don't need to go back and tell you the damage we've done, with our debt and where we are in the U.S. and globally. Just think for 1 second about Japan and the trouble they were in before with the earthquake and tsunami. And this is something people are talking about, but nobody's focused on. And these will be the driving issues going forward. Come the end of June, when QE2 is supposed to end, it's no secret, and I'll just tell you right here in case you want to hear from me, there's no way it can end. Now, they may call it something else, but it'll just be to us QE3. It'll be ad infinitum. It's going to be QE12 and 14 and 15. There's no way, because there are no other buyers for our debt. I saw one of the most amazing charts that showed the bank reserves and the way they have exploded since the beginning of this financial crisis in about 2008. And people wonder, who's buying all this Treasury debt? Well, it's our banks. It's our own banks. They've got to park that money somewhere. But the issue is this. They're only parking it of term securities. They're buying either T-bills or 1-2 year notes. They don't dare go out to the long end. And so I think everybody in this call probably knows, as the interest rate cycle I talked about earlier, as it changes, and we go through, and think about this, we go through what could be a 20-year period of increasing interest rates. Now that jives with everything commonsensically that we think should happen, because who's going to buy not just U.S. debt, but Japanese debt, Euro, buy all this debt? Especially when rates start to increase and people understand that the inflation scenario that started with the increased prices of gold and silver in 2003, right, that's now translating into higher prices for everything. I think it's so funny when you see these morons on CNBC and the talking heads in the mainstream media talk about rising oil prices and what could be at the root out of it. Obama talking about speculators being behind this, and we all know what it is. So much money's been printed. These are all priced, of course, in U.S. dollars. All these commodities are, and the more they're printed, of course, we know what has to happen. These commodities have to rise in price. These are all coming together for the first time with this kind of a dynamic of debt that is mathematically impossible to pay off. And so I'm spending a few minutes on this because I want you to think about where this cycle for commodities, precious is also a very long-term cycle, where this could go if I'm right, and if my parallel to the greatest equity bull market in history, culminating last, right? Think about the craziness of that. I watched, like many of you did, go public. They had than the market cap of General Electric, which at that time was still a major dollar company. There are companies going public that have market caps rivaling that with